Today I'd like to review the concept of false moves, or head fakes as they're also known, and it is generally a move outside or a breakout of consolidation, and it ends up ultimately reversing. Now, normally you want to trade a breakout, or typically you want to trade a breakout in the direction of the previous trend. Now, how do you determine trend? Well, the first thing you can do is, for example, we're looking at a 1 hour euro-dollar chart. We could tighten up the chart and try to go back and identify where the trend actually started. And here we see that it formed a bottom, but overall we're not really too sure. So we need to go to the larger time frames. Here's a 4-hour chart, and you can see that bottom that was formed here. So really it was in an uptrend even here on this 4-hour chart. You could measure some of these price swings, the low, the high. Here you have a 50% retracement, and then go to the daily chart. We're looking at the daily chart. So now things look a little bit different. We're in a clear downtrend here, but price is starting to reverse and either testing resistance levels. So we're not too sure at this point if it's a retracement or if it's actually going to bounce and move back up towards these highs. Anything's possible. It's a matter of using specific support and resistance levels to identify whether the trend is going to shift. So on this particular time frame, the daily chart, a significant area that price would need to take out is, of course, this price swing high. And then, of course, the next level would be these swing highs here. But also, at the same time, looking for Fibonacci retracement levels that could potentially act as support or resistance. In this case, resistance, because price was in a downtrend and it's retracing. So here's the 618 retracement level. But when you're trading intraday, let's go back to the 1-hour chart, it is possible to, at times, trade even opposite the trend. So let's open it up just a little bit more in here. There's a few things that you got to remember. When you start trading opposite the direction of the trend, which in this case is up, you can't or you should not hold onto the trade for very long. You shouldn't expect big numbers. You should definitely scale out or reduce the distance of the trade that or to the profit target that you're trying to achieve. Keeping in mind that you're going to do better trading in the direction of the trend. Notice how when price actually starts to form a little bit of a trend, here is a little trend that was in place for about 2 or 3 hours. It's all relative to whatever time frame you're looking at. But notice how it isn't, and it doesn't cover the same distance as trading in the direction of the trend does. Today we had economic data for the US. It came out about 10 o'clock in the morning Eastern time, and the numbers were for the most part bad, yet the market, after selling off, immediately reversed, and then so did the euro, so did the pound. It pulled back and the dollar dropped. Now we're going to analyze what actually happened here. The market opened up on Sunday. This is where the market opened on Sunday, and clearly we're looking at a 30-minute chart. We see some support levels taken out. Okay, so the market opens up. Here's a previous support level from Friday, and if we look at this candle, it closes right at it, but doesn't give. We trade a breakout of consolidation with a signal candle called the continuation trade, if you're not familiar with it. So the continuation signal candle has a 3-pip entry, meaning that if we get a signal candle, the next candle or the entry is 3 pips lower than the signal candle low. So it also has to close on the 1-hour chart, the signal candle below consolidation. So I don't get you confused, the continuation trade is a breakout candle. It's a breakout trade, and it usually puts us in the path of a big trending move or breakout. But we need to identify that continuation signal candle on the 1-hour chart, not the 30-minute. The 30-minute chart I'm using to identify smaller opportunities or quicker opportunities that also have smaller stop loss levels, like the Tech 1 trade. The Tech 1 trade is a very specific candle pattern, which is either a morning star or evening star or bullish or bearish engulfing candle. Of course, it depends on which direction you're trying to trade. So we do get a candle that closes here at support. In order to identify if this is a continuation signal candle, we must wait for a 1-hour candle to close below that support level, and it does not. It pulls back up. The first candle, now we're looking at the 1-hour chart, that prints a continuation signal candle is over here. Yet this caused that head fake. it pulled right back up and took out the price swing high that printed the continuation signal candle. Now, here's a tip. Something that I have found that helps me identify the possibility of a head fake and keeps me out of trades like this, shorting, even if I do get the 3 pip entry, which you see here on the white candle, is to use the fulcrums or the pivot points. Use the daily fulcrum. So the fulcrum on this candle stopped right into that support level. So I didn't short this. That's one thing that tells me be careful. You're running right into a potential area of support, which also was this swing high here from the previous week. This prevented me from taking this short entry even if there's no CCI divergence. That's another thing we've got to incorporate into this whole trade, is the confirmation of the indicator. If there's no CCI divergence, then it could potentially give me a confirmation, but the fulcrum is what stops me from getting out. What I'll do if I see the fulcrum and an old swing high, which could act as support or potential support, is wait and not participate in the 3 pip entry, but wait for price to pull back up and then look for resistance and form that Tech 1 candle pattern. Well, here's the Tech 1 candle pattern, but it took out the price swing high, which canceled the trade altogether, so I can't get in here. That's another way to look at it. It's another way to trade it. If the pivot point stopped and the old swing high, this support or resistance level, held price, it could be just temporary. And if it's only temporary, then again, as I said, we can watch for the retracement, switch to the 30-minute chart and look for the Tech 1 candle pattern. Again, we're looking at the 1-hour chart. I just want to identify these head fakes that set up during the week and how we could trade them. Now, here's another swing low. So this is a new low for the week. So let's draw another support level here, and we see another continuation signal candle that ultimately failed. Again, we're trading against the trend. On this continuation signal candle, the CCI did have divergence. And on this continuation signal candle, the CCI did have divergence. It does give the 3 pip entry, but if it has CCI divergence, we stay away from the trade. And if the fulcrum's running right into that support level, or if price is running right into that support level within just a few pips, it doesn't have to be stopping right at it. But I'll wait for the retracement and look for the Tech 1 candle pattern. Because if this is a new move and a new trend to the downside, it's going to give me another opportunity, which is a pullback to resistance, and then it'll form that Tech 1 candle pattern and give me a second entry opportunity. But we've got to use them on the 30-minute chart. Now, there was another continuation trade that developed in the opposite direction. So here's another tip. Here is the week's high here, and here's our continuation signal candle. And this trade potentially pays anywhere on the Eurodollar, anywhere from 55 to 65, and maybe even further if you can trail the trade and the trend remains strong. So we're going to do a lot better trading in the direction of the trend anyway. So we've already hit some of our targets trading this continuation signal candle to the upside. One last tip. Oftentimes when we get a head fake in one direction, from a continuation signal candle, the next continuation signal candle that develops is oftentimes the correct one. Now, there are times when that doesn't work, which clearly identifies consolidation. It means that you're seeing a breakout where everybody's participating in the move, and it immediately comes right back down into consolidation, which is exactly what we saw here. A lot of people anticipated a breakout to the downside, and it immediately rolled right back into consolidation. And then we get the opposite direction. This is oftentimes the correct direction. Now, of course, measure and confirm all of this data with your indicators, with economic data, market sentiment, looking at other markets for confirmation, watching the US dollar, watching oil, watching gold, looking for information that could help support your analysis and confirm your trade. Thanks for watching.